Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
New activation and upfront payment for 3-month plan required. Taxes and fees extra. Additional restrictions apply. See mintmobile.com for full terms.
This is a Shares for Beginners quick tip. Essential lessons, questions answered. One of the most important aspects of investing is deciding if the company is worth what you're paying for. In this quick tip, Carl McIntyre from Firetrail Investments talks about coming up with a valuation. Okay, now I'm just going to quote something that you said. The biggest decision you make when you invest in a company is the price that you pay for that company. Now that seems like a really simple statement, but I think for someone just beginning in investing in the share market, it's a very important statement.
Taking a step back when you think about investing in a company or you're thinking about investing in a stock, really what you're trying to do is value the underlying business, the earnings of that underlying business, and find out what those earnings are worth looking into the future. Now, there are some different variables that go into that, but if you take a step back, you can really think of it like buying a house. You research the suburb or the industry that the company's in. You research the home itself, the quality of that home, what you think it's worth, what other homes in a similar area have sold for. And the aim of investing is to pay less than what you believe that house or that company is actually worth. And so the biggest decision on your investment returns, in my view, is paying less than what that company is actually intrinsically worth. Now, how do these opportunities become available is the key question, because there are really three key parts to investing. The first is the fundamental side, and that is working out what you believe a company is worth, doing the research, modelling it out, looking at the earnings of that company and coming up with a valuation. The second part is psychological, and it is taking a view that is different to other people in the market, different to the average investor, different to the consensus view, and having the conviction to know that that view is right. Now, it may not be right in the short term, but if you have conviction in the long-term view there, then that's where the big opportunities become available. And the opportunity is finding something that is undervalued because the market or the consensus today believes something different to what you believe into the future. The final thing is the risk. And so what we look to do is reduce the risk or the impact of those macroeconomic events and take risk in picking the right companies.
Okay, that's a great explanation, because I think the statement that I was referring to when you, the most important decision is the price you pay for that company. A lot of people will take that as a very, or they mightn't look into the depth of it and say, oh, look, that stock's just, dropped 20%. It must be a good buy now. And this is a trap for investors, isn't it?
Oh, absolutely. I mean, the classic terminology is a yield trap, and that's when the price of something comes down, and so the perceived future dividend rises, the return that you get rises, but you've got to uncover the underlying reason for that share price decline. And we ask ourselves, what are the key drivers in the medium to long term of this business? The biggest decision you will make is, once you've worked out the earnings profile of a business, is how much are you willing to pay for those earnings looking forward? And there are some different factors you need to think about. How strong are those earnings going to grow? How long are those earnings going to grow? Are there structural challenges in the future? And you bring that all together into a valuation. And if that valuation today, if I believe that valuation is less than what the share price is today, then for me, that's a compelling investment opportunity. And it's not only the biggest decision you make, the price you'll pay, it's the biggest risk you'll take. Because as you know, if you buy a home, if you overpay for that home, the chances are it's going to take a very long time for you to get that money back or that return back for your home.
Every number is dependent on that initial payment price, isn't it?
Absolutely.
Everything comes off of that.
Absolutely.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
Acast powers the world's best podcasts. Here's a show that we recommend.
I'm Vanessa Zoltan, and I'm a Jewish atheist non-denominational chaplain.
And I'm Matt Potts, and I'm an Episcopal priest and a professor at Harvard Divinity School. And we co-host the podcast Harry Potter and the Sacred Text, which is a week-by-week read-through of the Harry Potter books, where we treat those books as if they were sacred texts.
What we mean by that is not that we think that the text is perfect or that we respect their author, but that they can teach us how to be more loving in the world.
Listen to the show on the Acast app or wherever you get your podcasts. New episodes drop on Thursdays.
Acast helps creators launch, grow, and monetize their podcasts everywhere. Acast.com.